Welcome to our today's lecture on European economics after a short break. Today we will discuss a very hot topic, inflation. And if you read newspapers, especially in Germany, financial markets are really scared about inflation. Although so far inflation is relatively low. Yesterday the figure came out 2.5% annual inflation, which is not very high. People are really scared in Germany. And there are many of op-eds and many of interviews among experts and so-called experts whether inflation will now become a real threat or not. And as you can imagine, how you assess inflation also depends on the models that you use. And especially in this debate on inflation, you can see how people refer to the two different models, to the classical model and to the Keynesian model. And today I want to give you a short introduction into the theory of inflation, so to say. And then I will also show you some figures, especially on inflation in the United States and on macroeconomic situation in the United States. So we can also discuss a little bit how big is the inflation threat, especially in the United States. Okay, so if you have the classical view on inflation, it's shaped by the classical view on money. And you might remember that in principle, money does not play a role in the classical model. And it's simply added to the real core of the economy. And the only way money is introduced is that it determines a price level. And as I said some weeks ago, this price level doesn't have a real role in this classical model. Anyhow, the core of the inflation theory of the classical model is the so-called quantity theory of money, which we have here. And this quantity theory of money was very much propagated by Milton Friedman. Milton Friedman, we've already talked about him on his views on monetary policy, on his ideas that the best thing the central bank can do is to do nothing, to remain passive, just to target a constant growth rate of the money stock. And in his theoretical view, the quantity theory plays a decisive role. And so the core message by Friedman is the sentence, inflation is always and everywhere a monetary phenomenon. And you can explain this with the quantity theory. And the quantity theory says the money stock times the velocity of money equals the price level times real GDP. This is a very simple equation. And that's why people like this monetary theory. It's so simple. You do not have to know very much about the structure of the economy. You do not have to bother about the transmission process of monetary policy. You just have this equation, and the equation says whenever there is more money, there will be an increase in the price level, in other words, inflation. If you look at this equation, it is a tautology, because if you take the money stock times the velocity and you get price level times real GDP, you have here the nominal GDP. And it's an identity. Why? Because you cannot directly measure the velocity of money. You can just calculate it by dividing the nominal GDP by the money stock, and then you get all kinds of velocities. So in order to become a real theory, which can say something on inflation, the monetarists assume that the velocity of money is a constant. And they also assume that real GDP is constant. And this applies to the view of the classical theory that you have a kind of stationary economy where GDP is just given. And so with a constant velocity of money and a constant real GDP, increase in the money stock must also lead to an increase in the price level. And so that's the key idea. And of course, crucial for the monetarist approach is the assumption that the velocity of money is stable. And if you look at the chart, you can see this is definitively not the case. One might identify some stable trends here for some period of time, but then, as you can see, in the 1980s, it went up and down, and there is nothing of stability in the velocity of money. And here we talk about later on, we have this huge decline in the velocity of money, which has to do with the huge increase of the money stock in the United States that we have seen now as a consequence to the pandemic measures, which we will explain a little bit in more detail. So, classical view, increase in the money stock must lead to inflation. Inflation always and everywhere a monetary phenomenon. And if we look at the data, we can see that this is not so obvious. So we can see that there has been a positive trend between the inflation rate and the money growth rate in the 1960s until the 1980s, but it was also in a very stable relationship. But then you can see that since the 1990s, this positive correlation has vanished, and so it's not very clear that money has a clear impact on inflation. And we can look at this also now in more detail if we look at the monetary data for the United States and for the euro area. And when we start with the United States, we see that we had two episodes with high inflation in the United States in the 1970s, 1980s. And at that time, it's true, there was also an acceleration of monetary growth. And I think that was a high time of the monetarists, where they could say, here you can see, when we have strong increase in the money stock, this will lead to inflation. But as you can see, in the subsequent years, we had several times relatively strong increases in the money stock, but we didn't see any impact on inflation. What is now really challenging is the enormous increase in the money stock M2 that we have seen now since the pandemic had burst out. And so this will be a real challenge, and that's why people are so nervous, why there is so much debate on inflation, especially also in the United States. Will this now lead to inflation or not? And I must say, I don't have the answer. So in the past, we have seen it's not a very stable relationship, but this is something unprecedented, something very unusual. And so it's not so clear what will follow. If we look at the euro area, the monetary growth rates for the euro area, here we only have data for the euro area inflation, because since 99, because the euro started in 99. And here we can see that we had a very strong increase in the growth rate of the money stock M3. In the euro area, the ECB assumes that the money stock M3 is the most relevant money stock for macroeconomic processes. And we can here see also, of course, in the last few months, also acceleration of monetary growth. But here the interesting fact is also that this strong increase in the monetary growth in the years 2007, 2008 did have no impact on inflation. So it's not so obvious that an increase in the money stock will lead to inflation. The question is, how can we explain it? What is the reason for this very weak or absent correlation between monetary growth and inflation? Because at first sight, the quantity equation looks very obvious, very simple, and so the question is, what is wrong with the quantity theory of money? And I see three reasons for the weak or even absent correlation between monetary growth and inflation. The first reason is that the quantity theory assumes that money is only used as a means of payment. There's no role for money as a store of value. So the quantity theory assumes if people are holding more money, they will hold it because they plan to make expenditures very soon. So the quantity theory increase of the money stock is a kind of leading indicator for consumption expenditures, because the only reason in this theory for holding money is the means, the use of money as a means of payment. That's obvious because in the classical theory, as I said, there's no obvious role for money at all. But the only way how you can give some room for money in the classical theory is that it is used as a means of payment. In the monetary, in the Keynesian theory, money serves not only as a means of payment, but also as a store of value. So Keynes, in a theory of liquidity preference, has elaborated that, of course, you need money as a means of payment, but also people use money as a store of value. I think that's one of the key insights of Keynes, that money has these different roles. And if you have money as a store of value, it means when people get wealthier, and that's what happens in the growing economy, people are also holding a certain percentage of their total wealth in money, which is deposits held with banks. And so an increase in the money stock does not necessarily increase that people want to spend more. It can also be an indication that people get more wealthy and that people are holding a part of this growing wealth in the form of bank deposits with the bank. And that's the key reason why we can see increases in the money stock, which do not lead to more consumption, which do not lead to more expenditures, and which do not have an effect on inflation. And of course, the role of money as a store of value is especially attractive if interest rates are low, because money typically has either zero interest rate or very, very low interest rates. Because the lower the rates of other financial assets are, the more attractive is money holding compared to other financial assets. And this is, of course, what we can observe today. So this is the one theory, the classical theory. Inflation is always a monetary phenomenon, and as we can see, it is not as simple. And therefore, I think it's also worthwhile to look at the Keynesian theory of inflation, which is more complex, which is more structured, because I think this monetarist approach to inflation is more or less a black box. It's a little bit this kind of helicopter money, there's more money, and then there will be inflation. And it's not so clear how the transmission process works from more money to inflation. And therefore, let's have a look at the Keynesian theory of inflation, which is somewhat more different as what we can expect. And in the Keynesian theory of inflation, it's always the relation of aggregate demand versus aggregate supply in the economy, which of course determines equilibrium output, but this then has an effect also on the inflation rate. Therefore, when we discuss inflation in Keynesian context, we have to look at the supply side and at the demand side of the economy, whether we can see causes for inflationary pressure. So what are the components of aggregate demand? Of course, it's private consumption, and then we can ask what determines private consumption. Of course, it depends on wages and employment, it depends on government transfers and taxes, and it also depends on the saving of households. Interestingly, the classical theory assumes that this intertemporal saving decision decides on how much people spend today, and we have discussed this in the very, very first lecture. But if you look at the evidence, there's absolutely no evidence for this intertemporal optimization, which is the cornerstone of the classical macroeconomic theory. And frankly speaking, if you ask yourself or your parents or your friends, is your saving decision determined by interest rates do you make this kind of intertemporal optimization, which the classical theory assumes everybody does. I don't think that many of you will use this kind of decision process to determine your today's consumption. So when we look at these three elements of private consumption, we can now ask, what do we expect for inflation in the United States, in the euro area, for the next few months and weeks and years? Then we can ask, okay, what do we assume about wages and employment in this post-pandemic world? And my guess would be that we won't see very strong wage increases. It's not very plausible, especially in the euro area. Unemployment is relatively high, and it will stay relatively high. So it's from this driver of inflation, of consumption, it's, in my view, it's not so clear that we will see inflationary pressure. It's a little bit different in the United States. In the United States today, everything is somewhat different because of the huge government stimuli packages. Institutions like the European Commission and the IMF assume that the unemployment rate next year in the United States will be below 4%. So there might be some inflationary pressure coming from the labor market. But on the other hand, in the United States, labor unions do not play a very strong role. In order to get a strong impact of the employment situation on wages, you normally need trade unions. This was the case in the 1970s when inflation also was very high in the United States and in Europe. And the role of labor unions is today very weak all over the world. And so it's not so clear. Then the second determinant is government transfers and taxes. Here we see in the United States a situation where government transfers have been huge, have really boosted the disposable incomes of the population, so people have more money than ever in the United States. So at least temporarily, this could create inflationary pressure in the United States. The euro area is different. Overall, governments in the euro area are much less expansionary in their fiscal policies than the United States. So it's a somewhat different picture if you compare the situation in the euro area with the situation in the United States. Saving is really high in the United States, and in the euro area, it's due to the fact that people were not able to spend as much money as they would have liked due to the lockdown. And so we have very high saving rates, which have increased the financial assets of households. Money stock is high. And so this could be also a reason for very strong demand pressure in the next few months and maybe years. And again, the saving rate in the United States has been much higher than in the euro area. So from private consumption, we might see inflationary pressure, but more, I would say, much more in the United States than in the euro area. Investment, of course, also has a role for aggregate demand to play. Here, it's not so clear how private investment will do after the pandemic. But again, the United States, there will be a lot of public investment. So again, from this side, you can also say, well, there is an positive impact on aggregate demand. And finally, government consumption is another component of aggregate demand. And here we can see that the attitude of the governments towards government consumption depends very much on the ideology, on the political economy in a country, and in the United States, but also in the euro area. We have seen a lot of austerity after the financial crisis. But today the winds are changing, especially in the United States. The new president is really willing to spend a lot. And again, I would say, yes, these are all arguments that could at least temporarily lead to higher inflation in the United States. So in the Keynesian model, we have these components of aggregate demand, and we know from the model if aggregate demand increases, that the supply side will respond, and that will lead to a higher equilibrium income. The question is then, how does this higher equilibrium income translate itself into inflation? And here we have to look at the supply side determinants of inflation. Of course, an important element of the supply side factors is the labor market. And here it's relatively obvious that the labor market situation depends on the wage increases in the economy. So if you have high unemployment, it's very difficult for the workers or for the trade unions to ask for higher wages. In contrast, if you have low unemployment, then of course it's much easier for workers and for trade unions to ask for higher wages. So the labor market situation is a very important element in the process of translating aggregate demand into inflation. Of course, the capacity utilization plays a role in the determinants of inflation, and energy prices also matter. So you can see now the relationship between aggregate income and inflation. If we look at the chart to our right, so we start in a situation where we have full employment equilibrium, and now we can translate the equilibrium income into inflation by using a relationship which is called Phillips Curve. I will explain this soon. But this Phillips Curve gives us a relationship between inflation and the capacity utilization of the economy. So, and it's upward sloping. The idea is the higher the capacity utilization, the tighter the situation on the labor market, the more inflation we'll have in the economy. So we have this upward sloping Phillips Curve. And so we start here with a situation where we have full employment, and we assume in this full employment situation where the equilibrium income is just identical with the full employment income, we have an inflation rate of 2%. And now we assume that due to government transfers, to government investment, other things, aggregate demand goes up. We get a new equilibrium here. And now we have an equilibrium which exceeds the full employment equilibrium. And here, then the idea of the Phillips curve is now this higher equilibrium income means that higher wages must be paid. It means that energy prices go up. It means that there is no excess capacities left. And so one can assume that this higher aggregate demand, the higher equilibrium income then lead also to more inflation. So that's the kind of core approach in the Keynesian model, where you can see that aggregate demand via equilibrium income and the Phillips curve have then an effect on the inflation rate. That's a little bit the key idea of the Keynesian model. And I think when we discuss the situation in the United States from a Keynesian approach, then we do not only discuss how strong was the growth of the money stock, we have to discuss how the situation on the labor market, how are energy prices developing, what is the effect of government spending on aggregate demand, what will the private households do with all the money that they have saved due to the high saving rates. So, and then we will discuss in much more detail, in a much more structured way, how the actual macroeconomization will then affect inflation today and tomorrow and the next few years. So the Phillips curve, which we have here in a very stylized way, was detected by Mr. Phillips in 1958. And so he just made a chart of the rate of money wages and of the employment rate for the United Kingdom for the period from 90, we have an old one, but it's also for other ones. No, here it's the right one. If here from 1948 to 1957, so the post-war period, and so the points here were just some individual years, in this period, and so he just took these points, and then he developed a curve which he fitted to the 1861 to 1930 data, which just went through these data points, and that's a Phillips curve. And that's a remarkable success because Mr. Phillips is really very famous. Everybody knows the Phillips curve, and it was relatively simple to find it out. But anyhow, each of us can, of course, try to find simple relationships and try to become famous. At least Mr. Phillips was able to do this. And so the original Phillips curve was just a correlation or relationship between the situation on the labor market represented by the unemployment rate and wage increases. And the logic, of course, is simple. If there are many people unemployed, it's very unlikely that we will see high wage increases. And if we have full employment, then it's relatively easy for workers, for trade unions to ask for higher wages. So this is so-called original Phillips curve, and it only describes the relationship between the situation of the labor market and wage increases. So now we have to come from wage increases to the inflation rate, and that's also relatively simple because wage costs are a main determinant of labor costs of the firms, and the labor costs are then a major determinant of the prices that firms charge. So one assumes that a kind of markup pricing, people take their labor costs and make a constant markup in the labor costs, and with the constant markup in the labor costs, you get a relatively simple relation then between inflation and the unemployment situation. And as a next step, in the 1960s, economists like Friedman realized, well, if you have wage negotiations, what matters is not only the labor market situation, many people are unemployed or not, but as you make a wage contract for several years in advance, trade unions, but also employers' unions ask themselves, what will be the inflation rate during the period for which we make a wage contract? So it's not only the labor market situation that is decisive, but also the expectations of both sides to a wage contract on the inflation rate during the time for which a wage contract is concluded. And so in addition to the labor market situation, expectations on the future inflation are also relevant for the Phillips curve, and that leads to the so-called expectations augmented Phillips curve. And expectations augmented Phillips curve, you have here as one term the expected inflation rate, and then here you have y, and y is the output gap. We talked about the output gap earlier. The output gap is a difference between the actual equilibrium income and full employment income divided by full employment income. So it's, correctly speaking, a relative output gap. And so one can use the output gap as a proxy for the unemployment rate. And therefore, very often, Phillips curves are not using the unemployment rate, but the output gap to represent the situation on the labor market. So it's the unemployment rate in form of the cyclical unemployment rate. Okay, so this is the Phillips curve, which is an important element in the Keynesian explanation of inflation. The interesting thing is that the Phillips curve, which of course in the chart by Phillips was very steep, has flattened a lot. You can see here a chart from The Economist, where you can see the Phillips curve in advanced countries from the 1975 to 85, 85 to 94, and then 95 to 2013. And you can see that the Phillips curve has become more and more flat, which is not so much in line with the idea of Phillips. And so there's a lot of discussion on what has caused this flattening of the Phillips curve. And I think this discussion is still going on. But some explanations are that the power of trade unions has been weakened in the last decades due to the decline of the share of manufacturing in the economy. So when you have people in the manufacturing sector, we have big, huge firms where thousands of workers go in and out every day. It's relatively easy to organize them. It's relatively easy for the labor unions to get these people as members. But the more we have a service-oriented economy where people are no longer going to big factories, it's much more difficult for trade unions to organize workers. And so that's one explanation, that the role of trade unions has declined considerably in all advanced economies. And another explanation is, of course, that we have a lot of wage pressure to the competition with low-wage emerging market economies, especially China. And of course, this exerts downward pressure on wages in advanced economies, because the companies can always threaten their workers, saying, okay, if you do not accept relatively low wages, we just move our production to low-wage countries somewhere in the East. I think this definitely has played a role. And I think this goes hand in hand also with the process of digitalization, robotization of manufacturing, where relatively standardized routines are no longer performed by workers, but the machines. I think these are some of the reasons that you can find literature. So the Phillips curve is there, but it has flattened. And of course, the question also now in the case of the United States is, can it steepen again? So in which direction will it go? But I think it's not so clear, because there are different tendencies. We have a stronger process of digitalization of the economy due to the pandemic, which can reduce the demand for relatively simple tasks. So if people are traveling less, it's less business travel. If people are working more from home, there are much less services needed than before the pandemic, and so that could reduce the demand for relatively low-skilled workers. And on the other hand, some economists are arguing that we see demographic processes, especially in China, where the society is aging, where there are less people in the working age. So Charles Goodhart, a very famous economist from the London School of Economics, is pushing this argument. I'm a little bit skeptical about it, because yes, in China you can see this process. In advanced economies, especially like Germany and Japan, you can see this process of aging. On the other hand, the rest of the world, there's so many very young populations in Africa, in Latin America. So I don't see that next decade we will be confronted with a scarcity of people who are motivated to like to work and which you can just allow to work in advanced economies, or also which can produce all kinds of things in their economies. So it's not so clear that the demographic pressures are a real threat for price stability, as it is argued by Charles Goodhart. Okay, so now we have seen these two different approaches to inflation, the monetarist approach and the classical approach. And so for the United States, and that's probably the most interesting case today, we see inflation pressure from both theories, so to say. You can see this very strong increase. The money growth M2, I've shown this already, and this is really unprecedented. So the data go back to the 1960s, so it's almost it's more than half a century. And this is something really unusual. So from the monetarist theory, you would say be careful. But interestingly, also from the Keynesian approach, you can see that aggregate demand is really pushed by the government. On the chart on the right side, you can see the disposable income of US private households. And here, the really remarkable fact is that the disposable income of US private households is 21% higher in the first quarter of 2020 than 2 years ago in the first quarter of 2019. This is also absolutely unprecedented. So the interesting thing is this, these transfers were already made by Trump, but now Biden has continued this. And so you have also from this side indications that there could be inflationary pressure in the economy. And you can also see it here again, also a nice chart, which shows real government spending in the United States. And it's deflated by the deflator for the GDP. And here you can see also this enormous spike that you can see on almost all charts for the United States. It's a huge increase in government spending. And in order to make it more obvious, I've also here a logarithmic scale, which is also a quite interesting way to show things. And the logarithmic scale has the advantage that absolute increases of a time series always are represented in a way that they show the same relative increases. So here, for instance, you can see, how to explain it. So if you have, for instance here, if government spending increases by 300 billion to, let's say, let's say if it doubles from 300 to 600, then it's an increase by 300 units, and it's an increase by 100%. If we have here, if you have at a level of 1300, and again we have an absolute increase of 300, this scale shows the same increase. Also 300 relative to 1300 is much less in percentages than 300 relative to 300. And this this representation, the logarithmic scale, has the effect that absolute increase is always represented in its relative increase. So you see the same relative increases. And I think that you see here nicely that we have had a relatively constant trend of real government spending for, again, from the 1960s to 2010, it's about here 2010. And then what is also interesting, we have seen almost a decade where government spending in real terms has remained constant. It's also very interesting. And if you know that government spending in the United States is about 30% of GDP, you can see that the government has really exerted has been functioning as a kind of brake on the economy. And then again, you see here this fantastic increase of government expenditures since the pandemic. Okay, so for the United States, both theories show that we have inflationary pressure. And the question is, can we reconcile the classical approach and the Keynesian approach? Are the situations where they lead to the same results? And I would say yes. If you have excessive government spending, then the Keynesian and the monetary approach more or less lead to the same results. And we talked about modern monetary theory, and I mentioned that is decisive for modern monetary theory, that that you apply the right dose, and that the government always takes into account the relation between aggregate supply and aggregate demand. This is what Eva Lerner postulated. And so the risk of modern monetary theory is excessive government spending financed by the central bank. And then both trends come together. And an interesting example is Venezuela, where the government has created a hyperinflation just by excessive spending, excessive deficits. You can here see the government budget deficit in Venezuela in really huge amounts, and you can see how the price index has exploded. Again, this is a logarithmic scale, otherwise it could not show it. And so the logic of such situations is that the government finances private expenditures with high deficits, and these expenditures exceed the supply of goods and services. There's just not so many products available. And so the people take the money that they get from the government and they spend it, and of course this drives prices upwards. And as the deficit is financed by the central bank, of course, this process also goes hand in hand with the increase of the money stock. So you have both elements. And then if you have a small economy, people do not only spend the money for domestic goods, they spend it for foreign goods. And then you get a current account deficit. Money flows out of the country and you get a depreciation of the currency. And especially in a small economy, a depreciating currency means that imports get more expensive. And so you get another strong impact on inflation. And then as a final element, if people are really scared about inflation, they are no longer willing to hold the money that they earn. So once they get their paychecks paid out, they take the money, spend it immediately, and of course, the storekeepers, shopkeepers who get the money, they also spend it again. And then the velocity of money starts to increase a lot. And then you're really in the process of hyperinflation. So yes, in hyperinflations and processes which are close to hyperinflations, you have both. You have a very strong increase of the money stock. You have also a strong increase of aggregate demand, which does not meet sufficient aggregate supply. And then, of course, it leads to inflation. Okay, so far, I suggest we make a small break and come back in 5 minutes. So let's continue. Now we've gone through the two models. We have discussed the mechanics. We have discussed the implications for economic policy. And at the end of this first part of our course, I would like to summarize the main ideas, and the message that I would like to convey is that these two models, these two paradigms are really not compatible. While this sounds not very fancy, it is absolutely revolutionary in a sense, because most economists today believe that somehow the two theories can be made compatible. So I think that's something that most economists believe. And what I want to show in this summary is that this is definitely not the case. So the idea that you can combine the classical model with the Keynesian model is presented under the so-called Neoclassical Synthesis. And this Neoclassical Synthesis goes back to Paul Samuelson, a very famous American economist, and he wrote the first kind of leading economics textbooks for the United States. I think the first edition was somewhere in 1948, and for decades, the Samuelson was the leading textbook in economics in the United States, but also in the rest of the world, like a little bit like Menkeu today. And it really shaped the mind of many generations of economists. And to Samuelson, and I think in the view also of many other economists, somehow you can combine the classical model with the Keynesian model. And this is presented under the so-called Neoclassical Synthesis. And I want to quote Samuelson, and he said, in recent years, that was 1955, 90% of American economists have stopped being Keynesian economists or anti-Keynesian economists. Instead, they have worked toward a synthesis of whatever is valuable in older economics and in modern theories of income determination. The result might be called neoclassical economics and is accepted in its broad outlines by all but about 5% of extreme left-wing or right-wing writers. So that is the key idea, that somehow you can combine classical economics and Keynesian economics. And that's what many people have in mind when we talk about neoclassical economics. And so as I'm not so happy with this neoclassical synthesis, I prefer to speak about classical economics and Keynesian economics, because in my view, these two models cannot be combined. And as an example for different paradigms, I like to use Ptolemaios and Copernicus with their paradigms on whether the sun rotates around the earth or whether the earth rotates around the sun. And if you have such paradigms, it's obvious that they cannot become compatible. So you have to make a decision which mechanics you prefer. And you can say, well, somehow we take some elements of Ptolemaios and some elements of Copernicus, and we try to get a synthesis of these two paradigms. And what I want to show you by just repeating what you said is that if you take the classical economics on one hand and the Keynesian economics on the other hand, you can see that their mechanics are as different as the mechanics of the Ptolemaic view and the Copernican view. And if models, paradigms have mechanics that go into different directions, you cannot say, just let's make a synthesis and let's combine. And that's the same thing with Ptolemaios, Copernicus. There was a guy called Tycho von Brahe in the 17th century, who tried to combine Copernicus and Ptolemaios, but it was called the Tychoan worldview, Tycho von Brahe, but it failed. It was not possible. You have to make your mind, does the Earth rotate around the sun or does the sun rotate around the Earth? And in order to underline this, I just want to go through the main mechanics of the two paradigms, of our classical paradigm and the Keynesian paradigm. And you can also call it real analysis or monetary analysis. Here we have it on the real analysis versus monetary analysis. So the real analysis is a classical model. The monetary analysis is the Keynesian model. And just going through the main mechanics, it's important first to look at the funds that are flowing in these universes. And here you have the fundamental difference that the funds that are flowing in these worlds are completely different. In the real analysis, we have this all-purpose good, which can be used for consumption, for investment, but also as funds, something that can be used in the financial markets, something you can borrow or lend, and which is a means of finance on the financial markets. And here, the fundamental difference in the Keynesian approach is that funds are always money. Money in this context is always deposits held with commercial banks. It can also be cash, but in most cases, the money, the funds that are used are bank deposits. So, and with these differences in what is flowing in the system, in the channels of the system, you also get a difference in what financing means. Financing in the real analysis means that households have to abandon consumption. And by abandoning consumption, the all-purpose good becomes available as a means of finance. So abandonment of consumption is the precondition for financing in the real world. The monetary world is completely different. Financing means you provide money balances to an investor, and these funds are provided either by a bank or by people who buy bonds on the capital market. And the precondition for financing the monetary analysis is that people are willing to give up liquidity. They're willing to give up bank deposits in order to purchase a bond. And for a bank also, if the bank provides a loan, we have seen it, the immediate effect for the individual bank is a loss of central bank reserves, and central bank reserves are the liquidity for the individual bank. So, third element, saving and investment. In the real analysis, the saving of households frees the all-purpose good and makes it available for investment. So only if people decide to save, investors will be able to invest. And here now we have an opposite causality in the Keynesian model. It's completely different. It's the investors who decide to take a loan to purchase assets, and by doing this, they generate income. Higher investment in the Keynesian model generates higher income. And out of this higher income, people are able to save more. So it's just the opposite causality. Here you very clearly see this can never be made compatible. You have to make up your mind. And I think what is important when we go through these different elements of these models, the models themselves are both fully consistent. So the real analysis or the classical model is in itself absolutely consistent. But you cannot try to combine it with the Keynesian model. That's when the problems come up. Okay, so let's continue. Another key difference concerns the role of banks. In the classical model, banks need to collect deposits, and once they have deposits, they can offer loans. So deposits in the classical model create loans. And the banks themselves in these models are pure intermediaries because they cannot create themselves the all-purpose good. They can also only collect it from the households and then give it to investors. So banks are pure intermediaries. And in the monetary Keynesian analysis, it's again completely different. It's opposite causation. It's the banks who create deposits by providing loans. And we have described this in detail, I would say. And then, of course, fundamentally changes the roles of banks. Banks are manufacturers of funds, they are originators of funds, and of course they are much more powerful in the monetary model, Keynesian model, because they can decide with their lending policies on the level of investment, and the level of investment, of course, determines the level of economic activity in general. So I think the example of banks makes it very, very clear how different these worlds are, like the Ptolemaic or Copernican worldview. Financial markets in the real analysis are not different fundamentally from banks. They do the same job. They're just intermediate funds that they cannot create. And they channel funds from savers who abandon consumption to investors who finance new investment. And here now in the monetary Keynesian model, financial markets are different from banks because financial markets cannot create money. They can only transfer money balances that were created by banks between different entities. So it's a completely different quality of what financial intermediaries, what financial markets do compared to the role of banks. And they are also channeling funds, but they are not channeling funds from people who save, but from lenders who are willing to abandon liquidity. And these lenders must not be saving in the same period. They are just willing to abandon bank deposits that generated maybe 10 years ago, to transfer bank deposits to people who are selling bonds. And it's also not necessarily new investment in the Keynesian approach that is financed from capital markets. It can be just existing financial assets like houses, like firms, or something else. So then we come to the central bank. In the classical model, the central bank is more or less powerless, but somehow it's able to control the price level, but the price level does not play a major role for this model. And in the Keynesian model, the central bank is the most decisive actor because it can determine the level of interest rates. And this level of interest rate is really decisive for investment, maybe to some degree also for consumption. And so the central bank is a very powerful institution that determines the interest rate. So that just finished, and this leads also then to the character of the interest rate. In the classical model, the interest rate is a real phenomenon. It's a real rate. It's units of the all-purpose good tomorrow relative to 1 unit of the all-purpose good today. And in the monetary analysis, the interest rate is 100% a monetary phenomenon, and the nominal interest rate is a rate of units of money tomorrow relative to units of money today. And it's always a little bit confusing. So when people talk about a real rate in the monetary analysis, you can do this. You can take the nominal interest rate and then you can subtract the inflation rate. Then you get something which you might call the real interest rate, but still it's a money interest rate deflated by the inflation rate, but it's not a commodity interest rate, which is the interest rate that you find in the real analysis. And then you finally have the flow of funds. And in the real analysis, it's a one-directional flow from savers to investors. In the monetary analysis, it's a circular flow starting from banks. That's where money is created. Banks are the source for new money. Money flows to investors. Investors spend the money, and then the money comes to households, to firms, and these people then are also able to save. So the savers are, so to say, in the end of the chain and not at the beginning. And what is also important in the Keynesian approach is that the money flow is circular. For instance, if I sell a house to somebody who wants to buy my house, and the money that I get for selling my house, I can just use it to buy bonds on the capital market, and so the money then money flow becomes circular. Okay, so far this summary of the key features of our two models. And if you then ask the question, can these two models be compatible? Can you have a synthesis of these two models? I would say it's relatively obvious you cannot do it. Because just the funds that are flowing in this universe are so different. So it's just like to combine a network for water with a grid for electricity. Yeah? So you cannot have electricity and water flowing in the same network. It's just not possible. And so in the classical model, in the system, it's this all-purpose good flowing from one participant to the other. And in the Keynesian monetary model, it's money deposits that are flowing within the grid. And so, yeah, like you cannot combine water grids and electricity or gas grids, I would say it's also from pure logic not possible to combine a real commodity grid with a money grid. But nevertheless, many economists assume that synthesis is possible. I've quoted Samuelson, and in one way how economists believe they can combine the two worlds is that they say, well, the classical model describes the long run with flexible prices, and the Keynesian model describes the short run with rigid prices. But as the mechanisms are so different, it's not clear why they should change their direction over time. At what point in time somehow the direction switches, and somehow then the banks who were able to create deposits just by lending are then suddenly forced to collect deposits from households. Where is the switching point? It's absolutely unclear. And I would say it's like the same logic if you have the Ptolemaic and the Copernican worldview, that you would say during the day the sun rotates around the earth and overnight it's just the opposite. So any idea to combine such different models, such different systems with such different mechanics, so it's very difficult to see how a synthesis is possible. And as I said in the beginning, this is something revolutionary, because almost all economists believe that this kind of combination is possible. And so, and of course, this leads to a huge confusion in economic thinking. That many people, even prominent people, believe you can combine them, or they're even identical. And we can send you today a tweet with an article by Paul Krugman on how the government deficits in the United States are financed, and he assumes more or less that private households finance government deficits of the United States. And this is, of course, a little bit weird, because we have seen that the government has made huge transfers to the household, increased their money balances. And of course, the money that the government has spent to make transfers to the household, the money comes, of course, from the financial system. And in the United States, the money comes to the government in the following way. So the government sells bonds to the commercial banks, and the commercial banks have to pay it, the government, with their reserves that they hold at the central bank. So when the first step, the government sells the bonds to commercial banks, reserves of the banks go down with the central bank, and the deposits of the government in the central bank increase. And as the government now spends the funds that he has received by selling the bonds, the government deposits with the central bank decline. And as the government makes transfers to the households, the bank deposits of the household increase, and the bank's reserves with the central bank also increase. So it's all the financing via the central bank and the banking system which provides the funds that go through the households. So it's not the households that finance the government, it's of course the government who makes financial surpluses of the households possible. And you can read the short op-ed by Krugman in the New York Times. We sent you the link, and you can see how confused such a prominent person like Krugman is, because he does not really see the difference between the two models. And as we are talking on Krugman, we can now also see in more detail how he confuses the two worlds, not only in today's tweet, but also in an article that he wrote about 10 years ago, and where he shows that he thinks that both models are the same. They can combine the two models. So there was an op-ed written about 10 years ago, and it was written at the occasion of the 57th anniversary of the publication of the general theory. And so Krugman says here, we have to relearn the seeming paradox of liquidity preference versus loanable funds models of interest rates. And so this paradox of these two models is exactly the Keynesian and the classical model. Liquidity preference model is a Keynesian model. And as I said, in the Keynesian model, people can decide to hold their wealth in bonds or in money as a store of value. That's a kind of liquidity preference theory by Keynes. And of course, the loanable funds model is the classical theory. And he says it's a seeming paradox. He says you can combine them. And so he then continues and say the natural inclination of practical man is to think of the interest rate as being determined by the supply and demand for loanable funds, as in figure 2. And here you have, as we have shown, here I have our classical model of the so-called financial markets. We know it's not really a financial market, it's a market for the all-purpose good, and you can say it's also the goods market for consumption and investment of the all-purpose good compared in relation to the supply of the all-purpose good. So Krugman says, okay, let's start with this. And then he said, so now we imagine that a rise in GDP shifts the savings schedule out from S1 to S2, and it also shifts the investment schedule, and as drawn, reduces the equilibrium rate in the market for loanable funds. So we start here, it's our starting point, and then Krugman says, okay, we assume that income increases, and if income is higher, people save more. So the savings schedule goes here. And we also assume that people invest more. That's the whole story. And they said, okay, now you compare the equilibrium points here. And we see now with the higher income, we have lower real interest rates, let's say from R1 to R0. So he says the effect of higher income in this loanable funds model is a decline in the real interest rate. So, and then he says, it's a little bit small here, but he says, as Hicks told us, and Keynes himself says in chapter 14, what the supply and demand for funds really gives us is a schedule telling us what the level of income will be for a given rate of interest. That is, it gives us the IS curve of figure 5. This tells us where the central bank must set the interest rate so as to achieve a given level of output and investment. So the idea, that's what we had already here with these two equilibrium points. Now, Krugman says you can just translate them, these interest rate levels. Now, and he would have here, so to say, you have here income 1 and income level 2. That says if you can, so we can derive from the loanable funds model, we can derive the IS curve of the Keynesian model. And I must say this kind of attempt goes back to Hicks. That's what Krugman said. Hicks, in its article on Keynes and the classics from 1940s, made just the same approach. Say, okay, we shift the savings and the investment schedule because we assume an increase in income, and then we see this relationship that a higher income goes hand in hand with a lower interest rate, and that is the IS curve. So at first sight, it looks convincing. I say, yes, sounds interesting. And here you have the synthesis of the two models. And of course, Bookman has been awarded with the Nobel Prize, and of course, somebody with this kind of skills, why should he not be able to derive the S curve of the Keynesian model out of the I curve and the S curve of the classical model? The question is, what is wrong with it? Is this really something which is true? I must say, when I wrote this for the first time, and there's a similar description by Michael Woodford in a very influential paper, I said, yes, it's nice. You shift a little bit the curves, and then just you have the S curve. How nice! But what is wrong? What is wrong with it? Well, one way to do it is that we now try to describe how this process of a higher income has to be described in the Keynesian model, the true Keynesian model. From the Keynesian model, we have our S curve, and in the Keynesian model, we can assume, like in the classical model, that we have investment demand that is downward sloping. But the important thing in the typical mainstream Keynesian model, saving is not determined by the interest rate; it's determined by income. So, and the question is now, how do we get in the Keynesian model? How do we get a higher income? What must happen? And the answer is, in order to have a higher income, we must reduce the interest rate, because if nothing happens with the interest rate, you cannot get a higher income in this model. Somehow you have the increase in income does not fall from heaven. It must be generated in the Keynesian model by someone. The someone is the central bank. The central bank, of course, can generate a higher income simply by reducing the interest rate. And that's what we assume. So we have here assumed that the central bank has set this interest rate by 0, and now it reduces the interest rate to I1. And given the S curve, yes, indeed, we can have a higher income. But the important thing now in the Keynesian model is that there is no shift of the investment demand. There's no reason for the investment demand to shift, because just if you have a lower interest rate, you get more investment. And yes, we get a shift of the savings schedule, because with a higher income, there will be more saving. So this shift of the investment schedule and the savings schedule is not something that would happen in a truly Keynesian model. So let us sum it up. What is wrong? And even before going into details, one can question the approach of Krugman, because he regards the I and the S curve of the classical model as a kind of financial market. That's what he says. And he takes something that he regards as the financial market, and out of this financial market, he derives the S curve, which in the Keynesian model represents the goods market. So what a nonsense. Yeah? So you have to be clear what you want to derive. And so I think that's the first flaw. Yeah? So if you really believe that the S diagram is the financial market, how can you derive from the financial market the goods market? Of course, you somehow in the purely classical model you can do it, because the financial market and the goods market are the same. But you cannot derive the goods market in the Keynesian model from the supposedly financial market of the classical model. But what's even worse, the shifts that Krugman makes, and other people also make, are completely arbitrary in their size. Even if you assume that both curve shifts, the outcome that a higher income is goes hand in hand with the lower interest rate, the outcome depends on the size of the shifts. And these shifts are completely arbitrary. And neither Higgs nor Krugman nor Woodford explain the size of the shifts. But what you can show is if you just assume that the shifts are a little bit different, so that saving shifts in this direction, and that the shift of the investment schedule is stronger than the shift of the saving schedule, then with the same logic, we see that the higher income goes hand in hand with a higher interest rate. And so if you then if you would combine it in a diagram like the S curve, you would have an upward sloping S curve. And it's really amazing that so far as I know, nobody has criticized it. Higgs, of course, he was a famous economist. Woodford is also a famous economist, and Krugman is also a famous economist. Normally, all these economists would ask for a strict theoretical rigor, but if the size of the shifts is decisive for the outcome, and you do not explain the size of shifts, it's a little bit arbitrary what they're doing. So, and of course, the final thing is that the interest rates in these two models are completely different interest rates. So this is classical. The interest rate is a real rate, commodity rate. And here it's in the Keynesian model, the interest rate is a money rate. And as I said, if the items that are flowing in the financial system are as different as water, electricity, or gas, we cannot just assume that they are flowing in the same circuit. Yeah? And so this is also a fundamental logical problem for this kind of synthesis, that it's completely different objects and different interest rates that are then relevant for these models. So, yeah, here I would like to stop. I think hopefully you enjoyed it a little bit. I think discussing this is really relevant and important, because if people are not aware of this difference, so much confusion is created. And in my view, if you follow some of the debates in the 1930s or 40s and up to today, they really suffer from the inadequate awareness of the incompatibility of these two models. And yeah, we will send you the tweet by Krugman and also the op-ed to which it relates, and you can see how much confusion is even in the mind of such a prominent economist like Krugman. And you can also send you a link to this. The Financial Times today also has made some major question marks on the reasoning by Krugman. And if you ask where does this come from? It comes from the inadequate awareness of the incompatibilities of two completely different paradigms of economics. And I hope after we have gone through this, that somehow you have this awareness, somehow you will be able to have a critical view on economic debates, that you will be able to see, okay, this guy is arguing that we will have inflation because he or she believes in the classical approach, or you can, in the discussion on government debt, you can see, okay, here you can see that someone has a crowding out model of the classical theory in his mind or her mind, and that's why this person is completely opposed to government deficits in order to boost the potential of an economy. And I think that's what I hope to have demonstrated so far with this course. Next week, we will present you a relatively simple macroeconomic model, which is mainly based on Keynesian mechanics. This is a model which we think is very helpful to deepen your understanding of economic processes, also to give you a kind of formal way to think about some processes, especially on shocks, demand shocks, supply shocks, and the way how the central bank can deal with them. And then in the subsequent weeks, we will then start discussing economic policy making in the euro area, what the European Central Bank is doing, the problems that the fiscal policies in the euro area are confronted with. And I think right now these are all very topical issues, and I hope that you will also like to hear more about these questions and issues in the next weeks until the end of the semester. Okay, so far I will stop. Are there any questions, remarks, suggestions, please? Oh, we can wait for a minute, maybe someone. Okay, then enjoy the sunshine, enjoy the world which is now opening to all of us, and hopefully we'll have now a time where we can enjoy ourselves. For those in Würzburg, and to our first time in Würzburg, you can see what a wonderful city it is. But also, I think for those who are listening from other places in the world, I think we have everywhere this process that somehow we are gaining back our old life. And the nice thing is then that we can appreciate how good this old life was. And maybe that's one of the few positive effects of the pandemic, that we see this old life was not so bad after all. Okay, thank you very much for listening.